Investor friends, Clay Winder here with exciting news. The real estate fund that I've been telling so many of you about is finally up and running. I appreciate your patience. Many of you have asked me for more details, you've wanted info, and I finally just grabbed the whiteboard, had Steph grab the phone. The kids are here in the house, but let's get it all out and let's get this out to you because we're up and running. So pop some popcorn and I'll give you all the details right now, but I wanted to start with the punchline first. Wakara Real Estate Fund is for real estate investors that want to put your money with me. Our target investor is anywhere between $100,000 to $500,000. We are buying homes right now in the target market of Georgia with plans, of course, to expand to other markets. And I'll go into more detail later on why Georgia. We do have a minimum of $50,000 for those of you that don't quite have enough to get up to where most real estate funds have their minimum, $100,000. That's the first unique factor about Wakara. Is for the minimum being down at 50 instead of 100 like so many. The second is we have a 8% preferred dividend. So they call it a pref, 8%. What that means is you are guaranteed 8% return on your money every year. So that's $8,000 a year on your $100,000. But here's another unique factor. It's real estate. I want it to feel like real estate. So we are going to pay out that $8,000 on a monthly dividend. So every month you can plan on your $666 hitting your bank account. So it feels like the cash flow from rental property because that's what we're buying. The last thing, of course, is our equity multiplier. Our goal for the entire fund is over 10 years. That's about the life expectancy of real estate funds. Our goal is that we 2.5 times all of our money through appreciation, debt reduction, and of course all the other aspects of owning real estate. So let's dive into the details of how we're going to achieve this. So why am I so excited about buying these homes in Georgia to begin with? It really comes down to the numbers. These numbers are the best numbers I have had in any of my real estate portfolio so far. And I want to dive into it. So first, we're acquiring properties through the BRRRR process, and then we're holding them as long-term rentals. So first, what is the BRRRR process? B-R-R-R-R-R. First of all, we buy it. We buy the home. Second, we renovate the home. Third, we rent the home. And then finally, we refi the home. And the last R is just the fun one. Repeat. Do it over and over and over again. So I want to give some real life examples of a home that we are purchasing right now. Like literally I wired the money yesterday. It should fund and record on Monday. I'm filming this on the weekend. This is on Bond Avenue in Georgia. So Bond, I just wired yesterday a purchase price of $53,000. We budgeted the renovation to be at $40,000. We are expecting through our property manager, who has done a very thorough analysis, that we will rent it for $1,300 a month. And we have done a CMA, comparative price analysis, similar to an appraisal, and have determined that we will be able to refinance it at a after repair value, ARV, of $130,000. So what does all this mean? It means just like flipping a house, we can create equity through this process. So we can make some money. So here's how we do it. If we have an after repair value, an appraisal that comes in at $130,000, and we're getting a 70-30 loan, meaning LTV, loan to value, 70% pulled out as a loan, 30% left as down payment or equity, it means we can pull out $91,000 for a loan. Right? So if you add this up, 53 plus 40 is 93. It means really in theory, we only need another $2,000 for a down payment. But let's not be naive. We know that the cost of this $93,000 for during the BRRRR process will probably come from a lender. Many of you have been my lender so far in this process. And that shakes out, I won't do all the math on this screen, but I've got the math sitting right there on the paper. On this process, we've been paying out, it's about $6,000. Many of you have actually received less than that because we did it so fast. I did the math based on 6 months, and I'll tell you why. It will take 6 months because refinancing a property in order to get the higher value requires seasoning of 6 months. So I ran these numbers based on a 6-month hold. Actually, I ran on an 8-month hold because I've got to wait 6, then I've got to refinance. I could take a month. To be safe, I did an 8-month cost of money, which is $6,000. I'm trying to be super conservative here, so I'm not fluffing anything. And then in addition to that, it cost about $7,000 in title fees, loan fees, and prepaid. So prepaid insurance, prepaid taxes, all of that. Now I know it's $7,000 because, you guys, I've done 23 of these homes already. And this is important to know. When I set out on this adventure, I thought I don't want to do hypotheticals and then get money from my friends and investors who are family, really close to me, unless I've proven the model. I just wasn't willing to take the risk. So all of these numbers are literal numbers that I am doing as we speak. Again, 23 homes. Bond, that we're using this as the example, is number 24. So with these costs on top of that, it means we've got a total cash invested into this home for the long term of $15,000. Now I'm sure your brain is going off like many people. Gosh, my handwriting is terrible. $15,000 to buy a home that rents for $1,300 a month is unreal. Like it is real. It's just not real in Utah. And that's been one of the reasons why people have asked, why aren't I doing it in Utah? We can't get these numbers right now here in Utah. Hopefully it comes back. It's going to take some market conditions to change to do it. But right now we are finding these in Middle Georgia. And like I said, later I'm going to talk a little more about why in Georgia, but the numbers are here. So $15,000 to buy a property like this is pretty incredible. So now let's go look at this rent. What does it create long term as we hold this property for that 10-year hold? So many of you guys have seen this example, but I'm going to bring it to what I call the 4 quadrants of benefits of owning real estate. The first one, of course, is cash flow. So the cash flow quadrant is the first thing we talk about when we talk about making money in real estate. Most novice investors only think about cash flow, and they forget that there's 3 other ways that a rental property makes money. But we're going to flow the burr right into the cash flow. So first things first, we're getting $1,300 in rent. At $1,300 in rent, we have expenses, of course. The first being a mortgage. Right now, again, the mortgage is this $91,000. Right now, I just had another closing on property number 23 last week that was sadly at an 8% rate. I say sadly because that's the highest rate I've closed at so far. I'm getting DSCR loans, those are debt coverage ratio loans, and those have been in the 7s. My first few at the beginning of this year were even in the 6s, but as many of you know, rates have gone up, but I'm still getting them in the high 7s, but this last one just last week was at 8, and luckily in the last 48 hours, rates have gone down. I'm praying and hoping rates go down, but again, for the sake of if we refinance here in 7-8 months from now, and rates haven't changed, let's run it at 8%. So $91,000 at 8%. I'm going to write this real small, you guys. Hopefully you can see it. I'll zoom in here in a second. Is $667 for principal and interest. We have taxes at, well, I'll do it right here, at $85 a month. We have insurance at $65 a month. And then we have property manager at $75 a month. And then I always calculate a capital expenditures, we call it CapEx, because these are fully renovated houses at my standard. My hope, of course, is that we minimize the repairs, the expenses that we might have with maintaining the property to about 10% of the rent. So every month we're going to calculate $130 based on a $1,300 rent for CapEx. So all in all, that gives us cash flow of $278 a month, which is, I should write this bigger, $3,338 a year. Now you divide that by the $15,000 to get our rate of return, that's a 22% return on our money just from the cash flow. Pretty big, right? So let's move on to the second quadrant. So now we move to the debt pay down. Because we have this $91,000 loan amortized on a 30-year, every time we make a payment, that of course comes from the rent, we're slowly paying down the debt. Now, an amortization schedule always makes the first year the worst year, and then it always improves over time. But based on that first year, I did the math. It's only about $62 a month goes toward principal. The rest is interest. But it comes out to $760 for that first year. Again, divided by $15,000 is still a 5% return on that $15,000. The next is appreciation. I'm writing so small you might not be able to see that. I moved the camera closer, hoping. We're buying homes in Middle Georgia. There's a lot of places in America that have killer cash flow, but one of the reasons they have such high cash flow is because so many people rent, and they're, for example, the market we're in, the stats I've been pulling is around 80% of people rent, but also because of that, the appreciation rate isn't terribly high. The stats that we have are showing that in our market, we're at about 1.5% appreciation. It's been higher than that. That's kind of the lowest it's been. And so I'm trying to be conservative again. But 1.5% appreciation every year on what we have is still $1,950. So again, you divide that by $50,000 and we have a 13% return on our money. Again, that's awesome. That's only 1.5 appreciation. America as a whole has been 4 point something from like the beginning of when we've been recording it, a little higher than inflation, their average, of course. The last one's a little more complicated, but the last one's also why many of you have reached out to me. And that is you want the tax benefit of owning real estate. We call this depreciation. Even though we have an appreciating asset, the IRS has said because it's built with earthly materials that decays over time or has a life expectancy, that you can depreciate the asset. So essentially how they do it is on a residential property, you'll take the purchase price, $130,000, and divide it by 27.5 years because they have dictated that residential has a 27.5 year life expectancy. So $130,000 divided by 27.5 years is $4,727 that you will be able to report as a loss at the end of each year that I will send you, Wakara will send us as a loss from our depreciation. That amount goes to your adjusted gross income. So if you're like many people on a 25% federal tax bracket with another 5 to 10% state tax bracket, let's just use 30% as an average, which means if you lower your adjusted gross income by that amount, you save 30% of that in taxes, which of course is $1,418. That's real money in your pocket. So again, divide that by the 15,000 and we have 9% return on our money. You guys can see where like rental properties, and many of you know this, rental properties just have such killer returns. We always only think about the cash flow, but we forget about these other two. And that's why many of you have said, well, would you ever buy a property that has zero cash flow? And I say, well, maybe. Right? If there's no cash flow, I still have an opportunity for these other three quadrants. So you add all of this up, you guys, we are making 49% return as a fund on our money that we're putting to work. 49% return on the capital is incredible. You survived the math part. This is the part where the attorney and this fine print is going to put a big asterisk on all of this. And I just want to make sure that we acknowledge it here in the video. This is the percentage, theoretically, that we'll make on the working capital. Now I say we, it's the fund that will be making the money. Your investment, of course, is based on the percentage of the shares that you purchase when you buy into the investment. So it's not going to be a 49% return on your money every single year, obviously. But what it does mean is that we're making enough money to for sure be able to take 8% preferred return on all of our money and monthly, which is cool. And that we'll be making enough money through debt pay down, through appreciation, that when we sell it here in 10 years, that we'll for sure be able to 2.5 times our money, assuming that these inputs are correct. So I just want to underscore that things could go wrong. Let's talk about what those things could be that go wrong and why your team matters. So first of all, what could go wrong is bad buys. right? So if we buy a property that for $53,000, put $40,000 into it, that cannot appraise in 6 months for 100, let's say it only appraises for 80, shoot, we just lost $13,000. Say we have a property that doesn't actually rent for $1,300. Our property manager was off on the estimate and misjudged that. Well, then it totally wipes out, a lot of our cash flow, which is one of the main reasons we're buying these specific properties, is because the cash flow is so high. What happens if the renovation team, the contractors, make mistakes, which causes our capital expenditures to be high every year? That could be off. I'm only pointing out these things because a lot of people have asked me why I haven't invested out of state sooner. Why now? Well, the reason now is because I have the confidence in my people that I have here on the ground, not here on the ground, but there in Georgia, that give me the confidence to know that we are bulletproofing this process. That's why I tested it first. I bought properties with my own money, and I've been doing this for the last year, is so that I could prove this model. And so far, our appraisals are hitting. So far, our rents are hitting. I can trust the property manager, and we're learning how much capital expenditures cost, what are our expectations, and the numbers are shaking out very, very well. So let's wrap up with just, I want to show you guys who the team is, and then if everything makes sense, let's get you involved. Let's start with the team I've got in Georgia. First, you'll see here I've got Noah and Tanner. These guys are the acquisitions team. These are the guys that are finding the properties, running the analysis, and making sure that they fit the buy box of what our fund is buying. Noah is particularly important because he's my guy. He lived here in Utah for several years. He joined Red Sign Real Estate team, which I run, and I trained him for quite a few years and saw him rise to be one of our top producers. And it was a sad day when he moved back to Georgia, but I was glad to stay in touch with him and to see him flip from the agency side to the wholesaling side, which is why all this came about. Sandy here is our property manager. Boy, does the property manager matter. Those of you that already own rental properties know that your entire portfolio can rise and fall with a good property manager, and she has proven herself to be absolutely invaluable to us. Cody Thorup and I are the general partners in the fund. It's our responsibility to manage it and to make sure that the funds are being managed well and that we're operating in tip-top shape. Middle Georgia, I mentioned to you guys before, this is our first market, mostly because of the team and because of the numbers that you just went through, but I wanted to point out we're south of Atlanta by about an hour and a half, primarily in Macon and Columbus. There's a community right outside of Macon called Warner Robins, and it's next to the Robins Air Force Base. I love the military bases. Columbus has an Army base, and I love those because it really creates a stable rental market for a portfolio. And I guess I'll wrap up with this, you guys. The mission and vision. This is what I would call a vanilla real estate portfolio, or like your rich uncle's real estate fund, meaning we're not like crazy speculative investors. We're buying awesome rental properties through the BRRRR process that simply have good numbers. It's relatively safe. It's collateralized by good real estate that lasts a long time. So thank you guys for banging through this video. If you'd like to get involved, like I said, we're taking soft commitments now. I'll create a queue of soft commitments so that we can have you guys come in at the same rate as rental properties come in. I'm gonna take the camera from my wife because the baby is now wanting to get involved. I told you, I'm making this video on the fly so we can get it out quickly because a lot of you have been waiting patiently. I'm just saying we'll have everybody make soft commitments first, and then we'll take in money as we're bringing in rental properties so that we don't have dormant money sitting in like an account not making returns. So I'll send you guys a link to make the soft commitment, and let's get rocking and rolling and continue buying some amazing properties. Thanks, you guys.